G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. This is our weekly 2 cents segment, and as I always am, I'm here with Chris Bates from the Alcove Group Mortgage Specialist. G'day, Chris. How's your week been?
Going well, Pete. Like I said last week on this, I do feel like I'm a bit boring at the moment. We are going away in a few weeks, so I'm looking forward to a trip then. But just in the winter trenches, and we've seen pretty much steady clients coming to us since probably the May 2nd cut, which I sort of mentioned on previous episodes, and that sort of continues. There's been another week of buying for clients, so it's quite a lot of activity, to be honest, even though it's only the start of July. It's a bit surprising. I made a post about that a couple of weeks ago, and it seems to be the trend that people are trying to get something as quick as they can at the moment, which I guess sets us up for a pretty strong spring. What's the news in your world, mate? How was the cricket?
It was amazing, actually. I went to Lord's last weekend, and it's first time in the members, so just going into the long room and seeing all the history and the all of the portraits of the players and everything like that. It was really, really good. It's almost enough to make me want to dust off the whites, but I'm not so sure about that at my age. Funnily enough, other half is she's trying to encourage me. She said, "Oh, you should get out there and start playing again." So she must want me out of the house, I guess. But we'll see. It takes me a while to get out of bed these days. So I think my business partner Andrew Freed he's been on a bit of a world trip himself over the past week or two. So we've been a bit thin on the ground, but back to it this week. And as you said, there's just been a slight sort of step up in urgency, I suppose, in the housing market. You can see it in some of the auction clearance rates and the Cotality data, and we're just feeling it as well. It's kind of it's a bit nebulous sometimes, but it's just in the tenor of people's inquiries sometimes. They just want to crack on with it and not leave things too long. I'm sure that's the case in Melbourne as well, but even in Brisbane, we're feeling it. People are just they don't want to sit around on the sidelines too long because there's just a sense that things are heating up. And Guy Smith in our team had just did a post on LinkedIn this week, just citing some examples of where the urgency and the number of bidders and the number of buyers is just taken a jump higher, I suppose, over the past month or two. So things picking up a bit. So what about in the mortgage world? Similar story?
Yeah, so I guess we measured in a number of ways. I mean, absolutely new inquiries, one, but how fast do people get their docs back after you have that first meeting with them? Once we've sent them a strategy, how fast do they come back to us, and then how fast do we send them a loan application? So it's all about the speed and, like you say, their sort of mentality and the urgency they've got there. And that's absolutely picked up since sort of May. It's interesting, though, the clients who probably should upgrade and probably should try to get a long-term family home, they're very scared, and they're on the fence about wanting to take on a lot of homeowner debt, and they're wanting to go down an investor route, and they're trying to delay their decision to upgrade. And I think that's just is a little bit of the carryover pain, I would say, of the last few years and being higher interest rates. And people are like, well, I'm just glad I didn't have a huge mortgage, or, I would have really struggled. And instead of maybe flipping that and saying, okay, well, that was, the pain of 2022 to 2025/6, that might not be the same pain that goes from 2026 to 2030. If we go into a decreasing rate environment, who knows how far they'll decrease, but that will often lead to an owner-occupier boom rather than just an investor boom. So I'd say that's an interesting thing for us just to track for the rest of this year, to do upgraders really take action and try to get themselves a long-term suitable home, or do they say, I'll worry about that, years down the line, I'll just be a bit more conservative on my home and I'll buy investment properties? Because I've had a number of conversations with clients, and it's really hard to get them to sort of consider that upgrade when potentially that could be a better move than, say, just buying an investment property and then, kicking that can down the road. What are you seeing, Pete?
Yeah, I think, we used to get a monthly sort of range of stats on this from the ABS, but then not so long ago, they went to quarterly figures. So flying a little bit blind on the lending stats side of things. I did see that AFG, Australian Finance Group, released their quarterly index, and that was record lodgements for the June quarter. But you could just see, just in some of those sub-indices, you can see a few trends just starting to emerge. Average mortgage size is at a record high, which probably isn't that surprising, I guess, given the way things have gone. But I think the things that stood out to me, interest-only lending, which had basically gone away for a period of time because it just became untenable. Well, that's crept all the way back again now. It's above 20% of loans again. So investors are starting to borrow on interest only again. But also the share of loans going to investors, 34%. That's just been creeping higher for a couple of years now. That was actually the highest since 2017. So you can see what's happening. Investors are starting to get active again. We know the first home buyer stimulus packages are kicking into gear. So there's going to be some competition at the lower end of the market. So, and it was fairly broad-based. If you look at the sort of record lodgement volumes, it's basically up everywhere. So there was no sort of one standout location. It's just a general strengthening in the market. So, I guess you'll be seeing that firsthand, I guess, in the mortgage broking world.
Yeah, I mean, the average loan's going up. It's even in tighter lending. So that's, it shows that there was a lot of people potentially borrowing around the country that were going up to their maximum because they didn't really need to, because the markets hadn't sort of boomed. When you look at Perth and Adelaide and Brisbane, particularly, those markets just been very, very strong over recent years. I'm sure a lot of borrowers in those markets are borrowing every single dollar they can get, whereas typically in other states, maybe they were, already doing that in the past because they were forced to. So I think even when, as rate cuts happen and borrowing capacity goes up, if you give people more money when they're already spending every dollar, it doesn't take a rocket scientist to figure out what they're probably going to have to do with that money, is to spend it to buy. So, what's some other stories you've seen around the traps, Pete?
Yeah, I think the sort of, most of what we've been talking about there is about more urgency. I think the only sort of thing on the other side of the ledger, Westpac's consumer sentiment survey was out this week. And I think with interest rates on hold unexpectedly last month, you could just see a bit of a paring back of house price expectations and also the time to buy a dwelling. So, and who knows, maybe the housing market strength might have been something that actually fed into the RBA decision. So I suppose that was one thing. There was a bit of an accidentally sort of leaked Treasury report this week, and you never quite know about how accidental these things are. But it was interesting to see that the Treasury is putting a review of the Commonwealth Rent Assistance on the housing options list. This was reported by ABC News Business. I think, it probably wasn't a massive surprise that report suggested that the government's target of 1.2 million homes won't be met. And it seems like quite a focus on potentially bumping up the rent assistance, which I think from a housing market point of view, it reduces headline inflation effectively. And I think what governments have found, particularly over the past couple of decades, something that Peter Tulip from the CIS has pointed out, is that I think governments are finding it easier just to give people assistance to rent rather than actually get involved in building social housing, because it's effectively it's easier, it's quicker, and it's cheaper. So, but it doesn't fix the problem of supply. So, that was one thing that sort of stood out. And we've got a couple of stories coming up in our big three stories of the week about the supply side of the market, because we can see that demand is picking up. No problems on that side of the equation, but the supply is really what's been struggling and what's been hampered, I suppose, over the past couple of years.
Yeah, I mean, it's Wednesday today, and basically the New South Wales government have released what you call their pattern book, sort of housing pattern book. Basically, I guess it's sort of going back to previous eras and, allowing people to build with sort of pre-approved, architectural plans that they can basically save all that money and basically pick a development or a type of housing out of a book and then say, right, I'm going to build that. And what I love about these is you see them on the Sydney Morning Herald and in the New South Wales government websites. But, you've got some amazing architects on there as well that have actually designed these, who have wanted to be involved. I mean, Anthony Gill is I love his style of architecture myself. We're doing a build in probably a few years and he's on our sort of short list. And, Carter Williamson's, the Saha team are amazing at what they do as well, Studio Johnson. So, yeah, I mean, it's worth having a look at those. I think it's a really, not just allowing people to build whatever they want, but actually building well-designed, sustainable, environmentally friendly, actual really functionable homes with a bit of sort of, inspiring style. And I think they're pretty exciting, these plans. Have you seen them, Pete?
I did, yeah. I think actually, well, let's segue into our first news story of the week, actually, because it is in many ways related. And Nerida Conisbee from Ray White did a piece on LinkedIn, how to build more cheaply. So obviously pattern book housing could be a key factor in that. Also, Cameron Cusher has been discussing in a few media outlets. He's an independent analyst these days, talking about the same subject. So let's sort of, I'll just feed in here what Nerida pointed out in her article. I mean, I guess we all know construction costs and particularly construction times have really blown out over the past couple of years. It's taking much, much longer to get stuff approved, get stuff built, which is, I guess, one of the ways in which pattern book housing can help out. Construction costs in Western Australia are still up double digits over the year. Queensland, we've still got a lot of pressures because we've got things like the Brisbane Metro, Cross River Rail, Olympics infrastructure projects. So Nerida is saying that modular construction could take 10 to 20% off build costs, and it could also be, I suppose, 50% or so faster than traditional construction methods. It feels like we've been talking about modular construction for at least a couple of decades, but at this stage, it's still only, I suppose, a very small part of the market. But it's not necessarily a fix for everything. I've got sort of family members are in the housing construction trade, and I suppose getting the sort of the main structure down is one thing, but you still got to do the plumbing, the wiring, the finish. Sometimes you've got to get roads built and so on, and get everything connected up. And I guess as Nerida points out, we've still also got labour shortages to tackle at the moment. The MBA says we need another 90,000 skilled construction workers. So yeah, Chris, this is something you must have talked about many times over the years on the Elephant podcast, and people talk about things like 3D printing, modular building, pattern book housing. Is it actually, it never seems to sort of filter through into lower building costs though. Is this something that's actually going to kick into gear over the years ahead?
Look, I think it is. I think you got to start somewhere, right? I think we had Archie Blocks on the podcast many years ago, and there's quite a lot of these module ones that have sort of come and some have actually gone. But I think, if you look around the world, there's countries, even you look at, Atlassian's building a massive timber tower at the moment in central Sydney. And, you going back 5 years ago, I think in Perth have just approved one of the biggest in the Southern Hemisphere. Actually, a friend is the lead architect on that. New timber tower in Perth. So I don't know. I think, Pete, that maybe they're slow to get off the ground. You look at build to rent. I mean, if you said sort of 5 years ago, was it going to have a huge impact on the market? You probably say maybe, but there's quite a lot in the pipeline. Does it really change prices? No, but does it, over time sort of grow if there's actual a value proposition there? And I think, I'm sort of hopeful that, modular building will absolutely, because it makes a lot of sense. I think at the current form and the way that banks look at it, it's not really supporting the industry. But we've already seen some changes from banks and their attitudes towards modular housing. I mean, I was trying to get finance for Archie Blocks about 5 years ago when they were, trying to grow that business. And one of their biggest handbrakes was they could only really sell to cash buyers. And yes, there are a lot of people doing builds that are cashed up. They're the baby boomers. Often they're getting to that sort of 50 age. They've made a lot of money and their kids have moved out and they haven't got kids' toys everywhere. So they're trying to get their sort of long-term home. And they're the ones with the cash to be able to fund these builds. But, if you're a family looking to sort of do a modular build on your block, you just couldn't get finance for it. The bank couldn't protect themselves. And so, I don't know, Pete, I think maybe now we haven't seen too much of it, but, you've got to, markets always shift, and I'm pretty hopeful on, and I'm a big fan of these sort of pattern book designs. I think what you don't want is people making cutbacks in the way that they do building. Build things that don't, visually are look nice in the suburb aren't sustainable, aren't going to be well built, and actually stick around for the long term, and are really going to not match the type of or the style of homes in certain suburbs. And so if we can have a minimum benchmark that people can do duplexes and multi dwelling builds without having to worry about paying, sometimes, hundreds of thousands of dollars to get decent architect plans done and to manage the project, I think it's a good thing.
It feels like in some ways everything that's old is new again, because I suppose after World War II there was prefabricated housing. I remember, this is going back some years, in the UK, people would often go to buy a house, and then when they came to get the valuation done, it would transpire that it's actually a prefabricated building with a brick veneer. The banks were just like, not going to touch it. You won't get finance on that. So, and then, those houses only sell to cash buyers and so on. But I guess with modern modular construction, that shouldn't be an issue. And as Nerida, just to wrap up on this story, says, the cost advantages, eliminating weather delays potentially, reducing waste through precise manufacturing, just economies of scale, which I think is where the pattern book housing comes in. You're not duplicating architectural costs sort of over and over again. But yeah, at the moment, the average time to complete a house has blown out from what was previously, it was around sort of 6.5 months in Australia. Well, at the moment, it's over 10. So it's everything's taking longer. At the moment, there's obviously a backlog. And separately, the ABS just put out the latest arrivals and departures figures just this week, and it was the biggest May on record for net arrivals, or net permanent and long-term arrivals. So even though we're sort of beyond the peak of the population growth crush, there's still a net increase of 450k over the year to May. So there's that side of things as well. We're trying to build more quickly, but we need to, because there's just a lot of bodies coming into the country at the same time. So that's I think we'll get back towards equilibrium eventually. But at the moment, obviously, still a lot of cost pressures, labour shortages, and it's just taking a long time to get stuff out of the ground.
Yeah, absolutely, Pete. But I mean, obviously, the whole construction industry is still got a handbrake on. The cost to build and what they can actually sell them for just doesn't match up, right? And so if I was a developer, I would be absolutely sitting on my hands right now. Yes, I've got staff, but there's no point building unprofitably. And I think that's what developers are making that choice to do. There's no point trying to, force a square peg into a round hole right now. You're better off just holding your land, working on your processes and your business and figuring everything else out, rather than actually just building and not making any money. Do you think that's the same in how the way the construction industry is looking at it, Pete?
I think it is, yeah. I mean, there's the incentive to sort of rush stuff through quickly. It just isn't there at the moment. I think it was the Turner and Townsend report last week that showed construction costs for Brisbane are over $5,000 a square metre estimated now. I mean, you're not making much profit on an apartment project at those kind of prices. I mean, Sydney and Melbourne ostensibly a bit lower, but then I would say, in some parts of Sydney it's probably higher again. So and if you're trying to build 100 plus square meters unit, well, the construction costs, they just make it very difficult to make profitable projects at the moment. So I guess that's the cycle, and that's why we get these sort of construction. We get a dearth of units, and then we suddenly get loads all at once. So let's have a look at this second story of the week from Cotality. Brisbane hits $1 million median house price. So in 2019, I guess this was something that we both had clients who were looking at Brisbane, because there was that sort of affordability advantage, particularly against Sydney. Population growth across Greater Brisbane has been 9.2% over 4 years, said Cotality. So, a couple of percent a year is a lot of people moving there. House prices are up 75% since 2020 to $1 million median. We've certainly noticed more people now looking at townhouses in Brisbane and in the blue chip areas. So if you go to places like New Farm or Coorparoo or Hawthorne, places like that, people will look at units now, which maybe 5 or 6 years ago people weren't doing that. I think they were a bit spooked away from the sector. So, I mean, obviously Brisbane now no longer has an affordability advantage versus Melbourne or Adelaide or Perth. Like, interestingly, they noted that the gap from Sydney is actually bigger than it's ever been. I remember I used to track this years ago when I had sort of more enthusiasm. And Sydney was like just over twice as expensive from a median house price perspective. I haven't looked exactly today, but it looks like that affordability gap hasn't really closed anyway, at least in dollar value terms. So, yeah, I mean, it seems that as interest rates come down, it seems that the enthusiasm for Brisbane is coming back again, but it just doesn't have the same affordability advantage against the other capitals now.
Yeah, but if you sort of are targeting a lot of the people, refugees out of Sydney, and Sydney's absolutely got a, societal problem, I feel right now, where, a lot of people are, and I've been talking about this for years, to be honest. I think in the last boom, 2016, 17, it was there in the COVID times when market was running. At some point, if people can't get, a viable long-term solutions for, themselves or their family, they're going to look at alternatives. And, an alternative might, if they're going to move to, say, Central Coast or Wollongong or regionally, then why don't they just up sticks and move to Brisbane? And a lot of people do want to go north, particularly as you get a bit older, you feel the cold a bit more, and it's been a very cold winter in Sydney this year. I think Brisbane's going to get a lot of people. That interstate migration, I can't see that slowing down. Whether they go to Brisbane, whether they go to Gold Coast, yes, they might go to Central Coast or Newcastle or, regionally New South Wales, but I think a lot will go to Brisbane. I think this whole COVID work from anywhere, remote work or work from an office, that battle is still continuing. I think at the moment it's some type of hybrid work and particularly, and maybe even more in the employer's favor rather than the employee, is where we're going to land. And so if they are going to move north, maybe sort of that too far from the city doesn't make sense. And then Brisbane makes a lot of sense. And I don't know, Pete, I'm interested to get your thoughts on the sustainability of Brisbane's run. I mean, yes, there's an affordability challenge for the locals, maybe, I don't know. But maybe that becomes easier as rates and borrowing capacity goes up. And, also that continual sort of confidence in the market, because when I look at listings in Brisbane, they're just so tight, compared to long-term averages. And, until that really starts to jump up, the market's still going to stay in very short supply. And you are just going to find, yes, some people can't afford, but there's still going to be a buyer pool that, is looking, it's really wanting to upgrade, and maybe it just shifts to all the medium and higher incomes who can afford to transact. But that's okay if listing numbers stay low. What's your take, Pete? I mean, there's a lot of confidence coming up with the Olympics over the next 5-6 years. Can you see Brisbane performing, quite strongly over that time frame, or do you think it's going to run out of steam?
I think it won't be as hot as it has been. I'm just looking back at the stats here. So Sydney's median house price is near enough 1.5 million and Brisbane is 1 million. So I guess in percentage terms, that gap is closed, but it's the dollar value is as wide as it's ever been. If you went back to the previous cycle, well, Sydney was kind of like double around. If you went back about a decade ago, it was about double the median house price of Brisbane. I think the challenge in Brisbane at the moment is that unit construction just hasn't picked up. I think if you went back to the previous cycle, we got this massive burst of high-rise construction. Brisbane City Council is quite amenable to approving units, townhouses, projects that were touch and go were just getting waved through, and everything was getting built really quickly. That's just not happened yet for a few reasons. I think that the construction cost is one of the reasons. I think as well, this time around, we don't have the overseas buyers to fund those projects. Last time around, there was a lot of Chinese investors were getting a lot of small units built, basically, and that's not happening this time because we've got stamp duty surcharges. So yeah, I think there'll be some life in the market for the next few years just because of the undersupply. I think Cotality showing their stats. If you assume if you assume 2.5 people per dwelling, it's a sort of a demand for another 94,000 dwellings over the past 4 years. Well, we just haven't built that. So in Greater Brisbane. So, for the time being anyway, it's onwards and upwards. I do think, though, at some point we'll get a construction boom. It's just the sheer cost of constructing, which has been a sort of an outcome from the pandemic, that's just really slowed things down. And, yeah, it's just taking longer than it might otherwise have done to get that supply response. And I think probably the same is true in Melbourne and Sydney too.
Yeah, I'm just looking at sort of SQM sort of property prices, and they do some really nice longer term charts, and it's just crazy when you look at places like Adelaide. All houses there were just flatlining since late 2008 to 2021, 2022. It was 500,000 was a house in Adelaide, and now you're looking over $1 million for houses in Adelaide. And if you look at sort of Brisbane, similar story, flatlined, all the way through to sort of 2021, maybe went up a little bit, 600, and now it's 600 to sort of 1.25 for the houses in sort of Brisbane. So it's just crazy.
It's pretty interesting, isn't it? I think if you kind of go back to 2020, it was so uncertain what was going to happen at that time, because we had shops were closed, nobody knew what the hell was going on, and then interest rates basically went to zero. Government started basically giving people furlough payments, or just effectively printing money as well. But there was all of that stimulus package, and it was very unclear what was going to happen. Well, as it's turned out, I mean, that inflation had to go somewhere, and some of it's gone into consumer prices, some of it went into cryptocurrencies, a lot of it went into housing. And yeah, the cost of construction is basically jumped 40%. So yeah, I mean, I guess all things considered, we've got an unemployment rate of nearly 4%, and we've come out the other side probably better than anyone might have hoped. But yeah, there's going to be some pain, and it's come through in consumer prices, house prices, construction costs, things like that. They've all felt the pain from what was a pretty unprecedented period, I guess, border closures, lockdowns, and all of that stuff. And I mean, you can see the outcome in all those graphs and charts that you talked about. The things were sort of trundling along. Unit prices in Brisbane were like that, no increase for a dozen years, and then bang. So yeah, pretty interesting 5 years or so.
Yeah, let's crack on with story number 3, Pete.
Yeah, so new data centre for Macquarie Park. These things seem to keep popping up all the time. I've got a couple of followers on Twitter saying, oh, well, another one. We're getting a lot of these IT and data centres getting built. I think this was an article reported in The Australian. So I think, I mean, when you look at the sort of the medium-term vision for hubs like Macquarie Park, it's basically, and same for places like Blacktown, it's basically just thousands of apartments, sort of mid-tier or medium-sized apartment blocks. At the moment, though, the apartment recovery has been a bit slow, as we already touched on. One of the reasons is the demand has shifted into things like data centers and things like that. But I think as well, I mean, the office space market has been really weak, because many more people are working from home now, and potentially office conversions to apartments or projects that were previously planned to be office space could actually end up being apartment space. So I think the demand for industrial property is clearly quite solid. It looks like sort of vacancy levels in the office market are just coming back down to earth. But it's just been I suppose this is just a bellwether, really. Macquarie Technology has forked out $240 million to pick up a data center site from Holdmark. So this is sort of the AI boom, it's sort of filtering into the real estate world. That site had been previously earmarked for, I think, 1,400 apartments. Now it's going to be industrial. So I suppose it's just as a bellwether for what's happening in the wider market. It seems like demand for industrial property is strong. The office market is gradually healing itself. But the apartment recovery at the moment, anyway, is pretty slow. Is that a fair assessment?
I mean, so I've sort of highlighted that I follow the urban developer religiously each week. One of my other little secret sites I like to track, it's a bit of a geeky of me, is Skyscraper City. I don't know if you've ever looked at that, Pete. So basically, it's a forum that basically tracks all new developments, and there's a lot of people that probably are on there way too much time. I look on it every few weeks and just have a look at the latest news articles. But what I'm sort of looking at is, new towers, commercial, but also you can go into different parts of, say, Sydney and have a look at what's getting approved from a medium dwelling point of view. And, these people are tracking every development. Probably a lot of them work in the construction sort of architect sort of industry or for the government, etc. And yeah, I think it's really interesting. I think Macquarie Park, absolutely, it's going to be a little bit of a boom along that sort of northern train line. Absolutely, some of the approvals or applications in for dwellings is, not what we've seen before. Parramatta just in recent weeks has had some huge new developments approved. And so, yeah, I think even Third Eye in that sort of corridor around sort of North Sydney to sort of Neutral Bay, all the way up towards sort of St Leonard's. There's a huge amount of developments going through there that, Third Eye just have one above the station there. They've got rid of the office. They're putting in more resi from what I just read. And so, yeah, I do think it's a bit of a sign of the times, but I think our city's going to evolve a lot, in terms of Sydney's is going to evolve a lot over the next decade. And, it's maybe not going to be what it was, say, 20 years ago. A lot of sort of poorly built, high density, just sort of around the airport. I think we're moving into an owner-occupier fueled building boom, rather than let's sell them cheaply, let's say developer boom that maybe is great for rental supply, but maybe wasn't the best build quality. And so, yeah, I'm really interested to see but I mean, the feasibility, like we said in story number 1, doesn't really make sense, but at some point, I think those numbers are going to make sense, and we're going to see a lot of new options in terms of housing.
Could be a bifurcation, I suppose, build to rent for the rental market, and the owner occupiers driving the supply for new apartments that people actually want to live in. So yeah, funnily enough, actually, just checked out some build to rent options because I'm following the Ashes around later in the year. But yeah, nothing doing really. They'll want minimum 6 months, and So yeah, I wasn't sure whether with some of the new projects they might be sort of more open to shorter stays, but it seems not. So running out of time as always. We've just got time for your listener Q&A, so we've probably got time for a couple of questions. So let's run through a couple of those. So the first one from A Failure, that's self-described, not something I've just said. So thanks for the question. Here it is. It says, I bought a luxury 2-bed, 2-bath apartment with parking facing the park and overlooking King Street on Hyde Park, King and Phillip. Off the plan, settling in May 2021. It was a bad move, I know, but driven by the pre-COVID market, more liberal overseas policies and limited Hyde Park options. I get $2,500 a week rent, but growth has been slow, and I'm now feeling the missed opportunities compared to my booming properties in Sydney, Tassie, Melbourne's been flat, and Cairns. I have a 50% LVR on it, which is limiting my scalability. Should I sell in September 2025 or wait until 2026? So I suppose there's two different things here. One is what's the market doing for that type of property? And I do track all this stuff with the auction clearances and so on. I've noticed, for example, in the Inner West, the auction clearance results for units are picking up in Sydney quite a bit. Now, this is probably a slightly different tier of the market because it's probably a bit more higher end. I must admit, I don't spend as much time around there as I used to back in the days of propping up the bar at St Pat's. But yeah, I think the market is generally picking up. I suppose the big question, Chris, is what about the opportunity cost? I think the sales price will probably be higher a year from now versus today for that type of property, but it could be that you're sort of holding yourself back from doing something better with your capital. So how would you normally assess that kind of question, Chris?
Yeah, so there's always a lot to unpick with these questions, and it's so hard to know what to do based on a couple of paragraphs, right? But these are some of the things that I'd be wanting to talk about, right? Why has he got a 50% LVR on it? I don't know. It sounds like it probably hasn't gone up. So why did you put cash in to buy it? I mean, really, it also shows you've got other properties. So really, you should have leveraged off your other properties to buy this. But was that because you were tapped out? I mean, what are you doing with your home? Where do you live? Are you better off to have that equity in a better home? That would be my next question. I mean, is this a long-term growth asset? I mean, I think you did. I mean, he's already sort of pointed it out that it's, it was a boom market back in 21 when they purchased this. So I know that development. It's actually a really nice development and a great spot there. So you can't knock the development, I guess.
I must admit, I've actually thought about buying there myself previously. I've got a place at One Darling Harbour, and there's not many places you think that would actually be better, but Hyde Park is really nice in some of those higher end developments. You could imagine yourself feeling quite special going in through some of those, those just beautifully manicured reception areas. But yeah, as an investment though, it's probably a bit sketchier potentially.
Yeah, exactly. I mean, I think as everyone's got that idea of Hyde Park and Central Park in New York, and you got Billionaires Row, which is 100 million plus for developments. And on the other side of town, you got people spending 100 million to live in the Crown Towers. I'd much prefer to be on the Hyde Park side personally, but and that view up there. But I mean, whether I would keep it or not, probably not. I think there's another massive development happening just a bit further south on Hyde Park. I think it's Hyde and I completely forget it's on a corner block there. It's near Victoria Road, near William Street there. The cross of William Street, and I think there's going to just be a lot more a lot more developments coming there because so I think I just wonder if I was a new buyer, I'm going to be saying this property is probably a few mil, at least, not just one or two. And if that's the case, I wonder if I was a buyer at that point, I would just go and buy something new off the plan. And that's one of the ultimate problems with off the plan is, people at that stage of life, they don't really want something a bit used. It's like buying a used car that's 2-3 years old. They want something that's brand spanking, a new development. And unless your development's got something really special about it, and that is a good spot, but I think there's other great spots as well. You're just going to always find that your buyers are often just going to go and buy the new stuff, even though, so your growth's just always subdued. And I think in this, you kind of did buy at the peak there. So personally, it's what like you said, Pete, the opportunity cost. What would you do? If you do sell now, what are you going to do with that equity? What's your borrowing capacity? What's your other options? If it's never going to be a long-term home for you, maybe you should just bite the bullet and get on with your next decision.
Yeah, I mean, one of the things I've sort of picked up over the years from doing these podcasts is that you might have certain assets in your portfolio that do well cyclically, but you might look to sort of buy and sell, but then you've got other assets you just want to hold on to because they're genuine A grade. And it sounds like this one might be the former. It's not really ticking all the boxes for you and not really necessarily delivering. So if, there's always transaction costs, and that makes it difficult. But if you don't think it's a long-term goer for you, then sometimes you just have to go through the pain of selling it to buy again and redeploying the capital more profitably. But I mean, I do think generally the market is picking up. It's just been a rough year or two in that space. So we've got time for one more question from a curious soul. Hello, this is my favourite finance podcast. Flattery will get you everywhere. So your question straight to the top of the queue. Could you tell us what are the most common risks a property investor with a low budget might face? What interest rate should I use to stress test my ability to service the loan and the investment property? Thanks so much. You guys are incredible. Well, I mean, I suppose if you're borrowing today, to a certain extent, lenders are doing that for you because they're applying a 3 percentage points lending assessment buffer. So it's pretty hard to actually overextend yourself on an individual loan now if you've got a low budget because the bank's already run quite a significant stress test. But Chris, if it's a point of concern for someone with a relatively low budget, what are the things they should think about? And do you have a rule of thumb in terms of running some kind of a stress test personally?
There's lots of risks. I mean, you said most common risks. There's quite a few. Let's just think about it, right? So if you've got a low budget, you probably got risks both on the building side and also the land side, because the price you can spend basically determines what markets that you can look at, right? And so let's just call it your budget, say 300,000. So you're obviously not going to be looking at capital cities. You're going to be looking at regionals. You might even be looking at the best part of regions. You might be looking at the tier 2, 3. You might be looking at the tier 2, 3 of those region locations. And so you might have very little scarcity in terms of land. You might also have issues with the quality of the economic environment in that location. It might be heavily due to, farming or, mining or whatever it might be. It might just have very little population growth. If anything, population declines, the brain drain. So your land quality might not be great. It might just be something that's A, not that scarce, and B, not that desirable. And so you're just not going to get that pressure cooker effect to push prices up. And then you've got to think from a build point of view. I mean, building's just so expensive. And so if you've got something that needs work, you need to maintain it. You could easily be blowing away any growth that you get, and also any rental income you get could be going in just maintenance, let alone rental risks in terms of just having a tenant. Some markets have, like you've got very strong population growth and there's real vacancy issues, and you can be getting a very good yield, but that can always shift as well. And so be really careful around tenant risk. You don't want to A, have no tenant, and then B, have a building you need to pay a lot of money to maintain to get a tenant, and then C, you're not even getting any growth because it's not scarce land. And so these are the major things, and it really shows why potentially the risk isn't worth the reward. And I think from a serviceability and a stress test, the main stress test you want to be doing probably isn't around servicing the loan. It's whether you can keep a tenant and whether you can maintain that market rent that you're hoping to achieve. So, because if you don't have the income, it doesn't matter what happens to the mortgage, to be honest, because that's going to really hit you. That would be my major concerns with low budgets, is the ability to actually maintain your rental income.
Yeah, lots to think about, and I suppose even above and beyond that, should you even do property at all? If you've got a low budget, maybe it makes sense to save a bit, maybe invest elsewhere. So lots to think about there. So that's about it for this week. So do send any questions that we can cover in our future Q&As, and drop us a line. Always keen to hear from you. And that's about it for 2 Cents this week, where we cover our big 3 news stories. Chris, what's on for the weekend for you?
Best mate's visiting from Newcastle, so that's going to be nice. And seeing my dad on Sunday. He's up from Melbourne. Hopefully get a game of football in, and hopefully enjoy these beautiful winter weekends. It's been cold, but it's been nice and sunny here. So, what about yourself, Pete? No more cricket?
No, I think I'm going to try and watch as much sports as I can get away with this weekend. So British Lions are playing, and obviously Brisbane Lions are playing, and there's NRL on as well. So I'll see how much I can get away with, but nothing too significant planned. I've got, before I head back to Oz, I've got one more trip away up to Scotland, to Edinburgh to squeeze in. So looking forward to that. So that's it for this week. So have a great Sunday, everyone. Always great to catch up, Chris, and look forward to seeing you next time around.
See you next week. Thanks so much.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.